The ability for SMSFs to have a maximum of 6 members now has increased their strategic effectiveness. Mark Ellem from Accurium has joined me to discuss some of the benefits that have come with this rule change. Welcome, Mark.
Hi, Darren. Great to be with you.
Now let's get straight into it. How can these new rules assist the effective transfer of SMSFs from one generation to another?
Okay, so first we know that an SMSF can go on and on and on. It has no real end date, unlike, if I can use the term, a normal trust. So in order for assets or a fund to transfer from one generation to the next, we need to keep in mind the compulsory cashing requirement when a member dies. So when a member dies, you've got to pay out the benefit as a death benefit, using that term, as soon as practicable. So we need to have enough assets to be able to pay out the benefit, but also then be able to retain the funds of the next generation. So if we have more members in the fund, assuming they're the next generation, we want to have the mix of those assets such that we can pay out a benefit, but at the same time, we've got enough to retain for those members to continue in the same fund and maybe to retain a particular or a specific asset. For example, the fund might own the business real property that is leased to the family business, and the business is being passed from one generation to the next. We want to be able to keep that property in the fund when we have to pay out one generation because they've passed away, and retain it for the next generation. So having those extra members in the fund can provide those extra liquid assets in order to achieve that strategy.
Okay, Mark. Well, what are some of the structuring options that can be used to achieve this outcome?
Okay, so if we move back to that popular asset of property that's in SMSFs, and particularly business real property, and as I alluded to, where it might be the property that's leased to the family business. If we have to pay out that death benefit, it might be that we end up in a scenario where the fund owns a portion of the property and the beneficiaries of the deceased member own the other portion, which can make things a little bit tricky and a bit messy. So one aspect is to effectively unitize that property. So rather than hold it within the fund, hold it in a separate trust. Now, obviously that would be a unit trust, for example, which would comply with the relevant rules such that it wouldn't be counted as an in-house asset. So when it comes to maybe holding that asset between the fund and the beneficiaries, because we've had to use some of that asset to pay out the death benefit, we simply are transferring units in that unit trust to the as an in-specie death benefit payment, and the super funds holding those units in the unit trust. And so we're having the activity happening in one entity, keeping it clean from an accounting viewpoint, having the profit distributed down to the unit holders, which could be the super fund and the beneficiaries, and also allows for over time for the SMSF to buy back those units from the beneficiaries, because they are units in what's regularly referred to as a non-geared unit trust. And that is an exception to the prohibition on acquiring assets from a related party rule.
Now, all of those benefits can apply to any assets. It's not just business real property. So if you have had an asset that was in the fund for a long period of time and there's a bit of an attachment to it, it can apply to that too, can't it?
Yes, it can, as long as we can retain it in the fund. Again, we've got to keep in mind that compulsory cashing in requirement when a member dies. That could be delayed for a period of time where we can pay out that death benefit as an income stream. So effectively, we can retain the capital in the fund and piecemeal it out, continually cash in that death benefit over time as the death benefit pension. Of course, that's going to be restricted by the recipients, the beneficiaries' transfer balance cap space, allowing them to receive that as a death benefit pension. And of course, they have to be an eligible recipient of a death benefit income stream. So it's generally a spouse or a child under the age of 18, and when the compulsory payout once they turn 25.
So from a tax perspective, does a 6-member fund help out there too?
Well, the tax rules will be the same regardless of whether it's a single member fund, a 2-member fund, or a 6-member fund. One of the aspects when it comes to taxing, when we've got a multi-member fund, is how the tax is then treated and allocated across the members. So whilst the the nominal tax on contributions, the 15% tax on contributions, is nominally deducted from the member's assessable contribution. And also if any of the members have insurance, those premiums would be deducted from their account, and the tax effect of that, that would be all allocated to them. What we must keep our eyes on is how then the tax across all the other investment income is going to be allocated across members, and also how any credits, for example, franking credits, might be allocated across members. Now, if we use the standard pooling method most SMSFs use, where everyone invests together, no member has specific rights to any assets or portfolio of assets, and that's going to be shared based on average balances or daily weighted balances over the year. But if we start looking at segregated investment strategies, and I'm not talking for ECPI purposes here, I'm just saying different investment strategies where we might have shares allocated to as a pool and allocated to certain members of the fund, then to consider, well, how is those franking credits are going to be allocated across the members? And that's where we look back at the fund's trust deed as to what it says, and it might simply say allocated on a fair and reasonable basis, which is what the legislation requires. So then it comes then to looking at our admin platforms. How is the admin platform going to allocate those franking credits, for example, across all the members of the fund? So I think from a tax viewpoint, yes, there's going to be the same tax rules that apply regardless of how many members there are. We probably need to focus more on the accounting side of that.
Okay, thanks, Mark, for sharing those thoughts with us. Mark will be discussing these points in more detail at the Self-Managed Super SMSF Professionals Day for 2022, to be held on the 31st of May. If you want to register for the event or find out a little bit more about it, please reference the details you can see on screen now. Look, thanks again, Mark, for your time today, and I look forward to hosting the Professionals Day with you in May.
Thanks, Darren. I'm looking forward to it.